Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. Tyler Crowe and I recently did a video about Airbnb, how it has gone from a no-profit startup to immensely profitable and generating substantial amounts of free cash flow per share. I'm Jason Hall. This is The Smattering. I've got Tyler back on here with me, and we're going to talk about how that cash flow generation that it has found and continues to grow, how it actually does something that is starting to concern Tyler a little bit. And we're going to talk about why this is a worry for Tyler. Hey, Tyler.
That is a really weird intro, but trust me, it makes sense when we start to discuss it.
Yeah. So again, just to recap, the thing that is so appealing about Airbnb is it's built this great platform that seems to have some real competitive advantages in terms of the network effect, drawing in more users, both for owners, but also people looking for somewhere to stay all over the world, and how that's generated wonderful operating leverage for this business as management stayed pretty disciplined with their operating costs and scaling up those costs and growing cash flow per share at a much faster rate than it's growing its expenses. As a result, Tyler, this is a business that now has a massive amount of cash on its balance sheets.
The $9.6 billion.
Nearly $10 billion. And there's a very good chance, depending on what management chooses to do with that cash, that by the end of next year, it could have $11, $12 billion in cash on its books. But the key, and I'm going to let the cat out of the bag, what management does with that cash, that's the thing that has you concerned. Tell us about it.
So one of the things that, and this is just thinking of other examples in Silicon Valley tech startup platform kind of idea, is this starting to invest in tangential things that end up not being that successful.
Peter Lynch's wonderful one-up on Wall Street, and he described the term as diversification.
Exactly. So the example I keep thinking about is Zillow. Had a pretty good basic model of we get a ton of traffic and we sell leads to agents. It's decently profitable business and been able to scale up to a point where it's profitable. But then they wanted to start jumping into other things and be the one-stop shop for the real estate transaction.
They didn't want to just be a place for insurers, lenders, like all of that stuff. They wanted to get in the mix of buying and selling the houses too.
Huge value destruction for the company as a result. Couldn't quite figure out the algorithm for pricing. We've all kind of seen iBuying not really turn out the way it's supposed to be. So my greatest concern with Airbnb is that management gets a little full of themselves, grab themselves by the suspenders like this, and be like, I think we can do something with flights or something like that.
Right.
And start to make some investment into making some silly super app that combines all of these things together. That's my greatest concern, because companies don't that often have no hits. It's a rarity. A lot of times you find something, you do it extremely well, and it can be value, and then you end up investing in a bunch of other middling businesses that don't do much. And that would be my concern, because I think that Airbnb actually has a good business here, but could pretty easily wreck it by trying to become more than that. And that's why I'm still sitting on the sidelines, because don't want to see management do that. With this much cash, you're a big boy company now. Do what big boys do. Pay dividends, buy back stock, return capital to investors. And that's, to me, what I want to see them do, versus get really stupid and buy Lyft. Who knows? Something like that, where it's just value destructive.